If a recession started tomorrow, most people have no idea what would actually happen to their money. Not guesses, not theories. I mean, step by step. Let's walk through it. You're about to see exactly how your financial world would change in real time, and more importantly, how to position yourself before it's too late. Because here's what nobody tells you about recessions. They don't affect everyone equally. Some people get crushed, others come out stronger. The difference isn't luck, it's preparation. So let's dive into what really happens when the economy takes a nosedive, starting with day one. The first thing that happens isn't panic, it's tightening. Think of the economy like a giant circulatory system, and suddenly all the arteries start constricting. Banks pull back on lending, companies freeze spending, hiring slows to a crawl. Your money doesn't disappear overnight, but it loses something equally important: mobility. Within the first week, you'll notice credit becomes harder to get. That home equity line you've been thinking about? Suddenly the bank wants 3 times more documentation. That business loan you were considering? The interest rate just jumped 2 points, if they'll even consider it at all. This isn't because banks hate you, it's because they're scared. And scared banks don't lend. Your investment accounts might actually look okay at this point. Markets are weird during the initial phase of a recession. Sometimes they're still riding high on optimism, thinking this is just a temporary blip. Don't be fooled by this false sense of security. Meanwhile, your employer is having very different conversations behind closed doors. Budget meetings become survival meetings. The marketing budget gets slashed. The office renovation gets postponed indefinitely. That new hire they promised, put on hold. They're not trying to be cruel. They're trying to stay alive. For your personal finances, this means your money starts behaving differently, even if the amounts look the same. Your checking account balance might be unchanged, but your options for deploying that money have quietly shrunk. It's like having the same amount of water, but all the faucets in your house suddenly have lower pressure. By week 3 or 4, you'll start seeing the first wave of job cuts. Not massive layoffs yet, those come later. But the consulting contracts don't get renewed. The part-time positions get eliminated. The temp workers get sent home. These early cuts are strategic, designed to reduce costs without creating headlines. This is when smart money starts moving. Not panic selling, but repositioning. People who understand recessions begin building cash reserves and reducing their commitments. They're not reacting to what's happening now. They're preparing for what's coming next. Now we hit months 2 through 6. This is when the damage really spreads. The initial tightening phase is over. Now we're in full contraction mode. Layoffs increase dramatically. Hours get cut for those who keep their jobs. Bonuses disappear. Commission structures get restructured downward. But here's what's fascinating about human psychology. Households don't collapse instantly. They adapt. And their first line of defense is their savings. People start dipping into emergency funds to maintain their lifestyle. They figure this is temporary. They'll replace the money when things get better. This is actually the most dangerous phase for most people because it feels manageable. You're still paying your mortgage. You're still buying groceries. You're still going out occasionally. Everything seems under control because you're essentially paying yourself to maintain normalcy. But you're burning through your financial cushion. By month 4 or 5, the savings are running low for many families. This is when you see the real behavioral changes. Subscriptions get canceled, dining out becomes rare, vacations get postponed, people start shopping at discount stores instead of their usual places. The economy begins shrinking not just because people are losing jobs, but because everyone who still has jobs is spending less. Credit card balances start climbing as people try to bridge the gap between their reduced income and their fixed expenses. This creates a vicious cycle because credit card debt is expensive, which means even less money available for spending, which means the economy contracts further. Small businesses start failing in waves during this phase, not because they're bad businesses, but because their customers have stopped spending. A restaurant that was profitable when people ate out twice a week suddenly can't survive when those same people eat out twice a month. Real estate begins to shift. Houses stay on the market longer. Sellers start reducing prices. Buyers become incredibly picky and demand concessions. If you need to sell your house during this period, you're at a serious disadvantage. Once savings are gone, vulnerability skyrockets. This is when families start making desperate decisions. They might cash out retirement accounts, taking the penalties because they need money now. They might take on high-interest debt. Some might move in with relatives or downsize dramatically. Here's where most people get confused about recession timing. They watch the stock market and think that tells them when the recession is over. But markets recover faster than real life, and that disconnect can destroy people who don't understand it. Markets are forward-looking. They start recovering based on hope and speculation about the future. Investors see a potential bottom and start buying. Asset prices bounce back relatively quickly once the worst fears subside. If you're watching your 401k balance, you might think the recession is ending after just a few months of market recovery. Meanwhile, in the real economy, jobs haven't come back. Companies are still cautious about hiring. Even when they do start hiring, they offer lower salaries than before. People who lost good jobs often have to take worse jobs to get back into the workforce. This creates a long tail of economic pain that persists well after the markets have recovered. This is why having a survival plan that depends on the market coming back isn't actually a plan, it's hope. And hope isn't a strategy. Your stock portfolio might recover in 6 months, while your job market takes 2 years to normalize. If you need to sell investments during the recovery phase to pay for living expenses, you might be selling right when you should be holding. The media doesn't help with this confusion. Once markets start recovering, headlines become optimistic. Recession fears fade, and market surge on recovery hopes dominate the news. But walk through any town during this phase, and you'll still see empty storefronts and for lease signs. The disconnect between financial markets and Main Street can persist for years. This brings us to the crucial question: how should you position your money for this reality? The goal during a recession isn't maximizing returns, it's maximizing optionalities. You want to preserve your ability to make choices when opportunities arise and when emergencies hit. First priority is building a substantial cash buffer, not the typical 3 to 6 months of expenses that financial advisors usually recommend. During a recession, you want at least 12 months of bare-bones living expenses in cash. This isn't just for job loss protection, it's for opportunity protection. When everyone else is forced to sell assets at low prices, you want to be the one with cash to buy. Second priority is minimizing fixed commitments. This means avoiding new debt, especially variable rate debt. It means being careful about long-term contracts. It means choosing flexibility over slight savings. That 5-year cell phone contract might save you $10 a month, but it eliminates your ability to cut that expense if needed. Third priority is developing multiple income streams before you need them. The time to start a side business or freelance work isn't after you lose your main job. It's while you still have your main job and can invest time without pressure. Recessions create opportunities for people who can provide value efficiently and affordably. Fourth priority is strategic positioning of existing assets. This doesn't mean timing the market or making dramatic moves. It means understanding what you own and why. If you have investments that require ongoing contributions to maintain their value, those become liabilities during a recession. If you have assets that generate income independent of your job, those become lifelines. The harsh truth about recessions is they don't destroy wealth, they redistribute it. Money doesn't vanish from the economy. It flows from unprepared people to prepared people, from those who must sell to those who can buy, from those with fixed expenses to those with variable costs, from those with single income sources to those with multiple streams. Most people approach recession preparation like it's a natural disaster, something to survive and endure. But recessions are actually massive wealth transfer events. They separate people who understand money from people who just have money. They reward preparation and punish assumptions. The next recession will happen. Not maybe, definitely. Economic cycles are as predictable as seasons. The only questions are timing and severity. But if you understand what actually happens to money during these cycles, and if you position yourself accordingly, you don't have to be a victim of the next downturn. You can be one of the people who comes out stronger. The choice is yours, and the time to make it is now. Please like, subscribe, and share to follow us and see more content like this. Check our other videos. New content weekly.